And here we go.
All right. We are getting started, everybody. Let's just wait about another minute. See if we get more people joining here. And then we'll get this started. All right. Let's go ahead and jump right in. I want to thank everybody for coming. First of all, this is the changes in 2021, what you need to know about your taxes, markets, and estates. And again, thank you all for coming. My name's Karl Eggerss. I'm one of the partners at Covenant, and we're a registered investment advisory firm based in San Antonio and a fiduciary. And let me introduce the rest of the presenters. We've got 3 people with facial hair and 1 that does not. So we're going to, let me first start off by introducing Shawn Morris. He's a certified financial planner. He is one of the other advisors at Covenant in the striped blue shirt, we'll call it, without glasses. That's how we're distinguishing. Then we have Eric McGraw, the one in the cool goatee. He is a CPA and senior tax manager with ADKF, also based in San Antonio. And then the distinguished gentleman that it does not have the facial hair is Johnny Lane with Lane and Countryman, and he'll be focusing on the estate planning section today. And so here's the format we're going to do today. Each presenter is going to present for about 15 minutes, and then at the end, we will spend the last 15 minutes doing the Q&A. What you can do during the whole presentation, you should have a tab that says chat. You can enter your questions there. I will be moderating that, and then we'll take those questions. And at the end, I'll sprinkle those out to the presenters, and we hopefully will get your question answered. All right, now that the housekeeping's out of the way, let's go ahead and get started. So we're going to start with Eric McGraw, again, CPA Senior Tax Manager with ADKF.
Thank you, Karl. Just let me know if you can hear me.
We're good.
Awesome. Well, thank you, everyone who is joining us today. We're going to talk first about the wonderful world of taxes and who's going to pay more taxes and who might pay less taxes. Here's me when I had more hair. I've been in public accounting for about 12 years, specializing in tax. I've worked with Fortune 500 companies. I've worked with taco trucks and everything in between. I work for ADKF, which is the largest locally owned accounting firm in San Antonio. We provide tax services. We provide audit services, yada, yada, yada. We are happy to talk to you if you'd like to talk to us. We have our main location in San Antonio near the airport. We also have satellite locations in New Braunfels and also in Boerne. There we are up at the top. We're right next to Mary's Tacos across the street from the post office. So come talk to us. We'll have a taco and then we'll go get the mail. So I thought it might be interesting or important to relay to you where I got the information for this presentation, because there is not a whole lot written in stone yet as far as tax reform goes. The main source that I've used for this presentation is President Biden's campaign white paper on taxation that outlined a number of ideas that his campaign, his team had on tax reform. And then also more articles and webinars and seminars and podcasts than I can remember from all sorts of people, mostly large accounting firms and industry publications. So I'd like to talk to you about a very brief overview of the reform, a magic number that you might need to know about, increases, decreases, what do we know, what do we don't know, and what are we going to do about it? So our political situation at the moment is a mirror of the political situation in 2017 when the Republicans controlled the House, the Senate, and the White House. They passed the Trump tax cuts, or the Tax Reforms and Jobs Act. That was the last time we had major tax reform. Now the situation is reversed. The Democrats control the House, the Senate, and the White House. And they may pass their own major tax reform package. Perhaps this will happen in conjunction with COVID relief. Perhaps it will be a completely separate piece of legislation. Their majority is small, and they will need moderate votes in order to pass legislation. I recently read some quotes from some of the moderate Democrats that at the moment they don't have a great appetite for passing tax increases. But then again, I wouldn't rely upon what a politician says. Another quote that I read recently was from the Senate Finance Committee chairman, who said that the policy wonks and the people behind the curtain, so to speak, are currently working on drafting tax reform legislation. This has not even gotten to the committee level, from what I understand, but they are working behind the scenes to start pushing this forward at some point. With that said, we just got through with an election, but we've got another one coming up in 2022. And so it'll be interesting to see if the Democrats try to push forward tax reform before that point, or if we get perhaps too close to the 2022 midterms and they decide to hold off because they think it would be too dangerous. We'll see. I think in general, the closer we get to those midterm elections, the less likely tax reform is. That's my opinion, for whatever it's worth. Now, President Biden's general position on tax reform is that some people need to pay more, which is corporations and high net worth or high income individuals, in order to fund various efforts on climate change, healthcare, education, et cetera, et cetera, et cetera. So President Biden is in favor of overall increasing taxes. He also provided to us in his campaign white paper a magic number. And I'm very sad that my PowerPoint effects are not working here, because on my computer, I could press a button and the 400,000 would appear out of the hat. So that's unfortunate, but we'll deal with it. This $400,000 figure is a number given over and over again. And the gist of it is that in that white paper, President Biden states that people with an income under $400,000 should not see tax increases, but people with an income over $400,000 will see tax increases. And this number is repeated numerous times through various provisions. Let's get into some of the specifics of those tax increases. The first one that pops to my mind was simply increasing the top marginal rate. Currently, the top marginal rate, the highest rate at which your dollars will be taxed, is 37%. That's the top marginal rate. That doesn't mean that every dollar you make is taxed at 37%, but it means that your marginal rate is 37%. Before the Trump tax cuts, that number was 39.6, and President Biden would like to see it return to 39.6. So that would be an immediate tax increase on anyone who's in the highest tax bracket. Here's another big one. This one will really affect Karl and Shawn and those guys. There is the thought that some people should not get to use the favorable rates on long-term capital gains. You know, currently, if you have a long-term cap gain, you're going to pay 15% or 20% tax on that, plus perhaps your net investment income tax. President Biden's white paper suggests that if your income is over $1 million, you don't get to have that lower rate anymore. You're going to pay your marginal rate on your capital gains, which would, dramatically decrease your return on investment from those investments. So that one's a rough one. Another one that would be very, very rough is a lowering of the estate tax exemption. And I don't want to steal Johnny's thunder on that. I know he's going to talk about estate taxes and estate planning. So I'll just say that this is an issue that comes up over and over and over again in tax reform. Politicians from both sides play with estate taxes almost constantly. And so one really has to be on top of an estate plan, and then I'll leave the rest to Johnny. Let's go from that to one that is really weird. This is a weird one, folks. This next one is a microcosm of our American tax system. So let's talk about Social Security taxes. People pay Social Security taxes on their earned income, their W-2, their job, if you will. If you're a business owner, you might also be paying self-employment taxes in place of Social Security taxes. Those Social Security taxes have a limit to how much you have to pay. They cap that earned income amount at around $140,000, meaning that if you make more earned income than that, you don't have to pay any more Social Security tax because you're not going to get a benefit for it on the back end. Well, a suggestion has been made that we keep in place that roughly $140,000 limit, but then we reinstitute Social Security taxes after $400,000. To repeat that, you'd pay Social Security taxes below 140 and above 400, but not in the middle. And if that's not the American tax system, I don't know what is. Some additional tax increases. Here's an old favorite, the return of the P's limitation. This was a limitation that's been off and on for quite some time. That's basically a cap, a soft cap on your itemized deductions. In other words, you give $100,000 to charity, but you make too much money, so we're only going to give you credit for giving $90,000 to charity and thereby increase your taxes. This limitation has been gone for a while. President Biden has talked about bringing it back into the fray. Let's see. How about a limitation on a relatively new tax deduction, the qualified business income tax deduction? This was new with the Trump tax cuts, very important to small business owners and often real estate investors who get to take advantage of this deduction on qualified business income. As you might imagine, the actual rules are quite complicated. There's various hoops you have to jump through, various limitations, yada, yada, yada. But President Biden would like to add a hard phase out or a hard cap for people making over $400,000 a year, where they simply would not get this deduction anymore. Yes, folks, we've got more tax increases. Here's another one that would hit folks in the real estate industry very hard. How about just a complete elimination of 1031 exchanges? We saw a reduction in 1031 exchanges under President Trump's tax cuts. We got rid of being able to trade in equipment and trucks, but we can still do 1031s on real estate. President Biden has suggested getting rid of that entirely. This would dramatically increase taxes for folks invested in real estate, especially folks that have taken advantage of 1031s in the past that have deferred lots of tax into the future. And if they sell a property that has a lot of deferred tax on it, a lot of deferred gain, man, they are going to be hit with a huge whammy, a tsunami of taxes on that sale. So if anybody's listening who has taken advantage of 1031s in the past, this is extremely relevant to you. Then we also have some increases that are more applicable to corporations, C corporations, rather than small business owners, which I won't go into detail on, but President Biden would like to increase their taxes too. So let's just pause there for a second and appreciate the wisdom of Benjamin Franklin with his famous quote, you know, in this world, nothing is certain but death and taxes. It's true. Let's talk now about some possible tax decreases. Now, it's unclear exactly who would qualify for these credits that I'm talking about now. I don't know if they would be completely unavailable for folks making over $400,000 a year, or if there would be a phase out, etc. But these credits, these enhanced credits, additional credits, are also mentioned by President Biden. Credits on this page concentrate on child care, child expenses, giving care to relatives, enhanced credits for folks that are taking care of others in their life. The first-time homebuyer credit might return. That was a credit very popular about 10 years ago, probably helped our real estate market a lot. Perhaps the return of it would help a market that's already hot. I don't know. A new credit would be a credit for renters to try to help them with the high costs of rent in various places. And then also an entire slew of energy-related credits, green credits, if you will, related to purchases of EVs, Teslas, solar panels, more efficient utilities, et cetera, et cetera, et cetera, for home builders, business users, residential users, all sorts of things. Having said all of that, there's a lot of unknowns here. As I already mentioned, we don't know if any of that's going to happen. We don't know when it's going to happen. We don't know if it's going to be retroactive. But a lot of people have these questions, and so I thought I'd talk about that for a second. The timing of the legislation, if it happens, is going to be very critical in what year it applies to and how retroactive it can be. Let's envision a scenario in which tax legislation does not occur in this calendar year. It's pushed into 2022. People are already filing their 2021 tax returns. Can Congress change the tax law when people are already filing their tax returns? They can. They can. But generally, they only go backwards across a calendar year if it's something beneficial for taxpayers, generally. So in other words, for 2021 taxes, if we do not see tax legislation in 2021, then we're probably not going to see horrible changes in 2021, if that makes sense. So for 2021 taxes to be affected, we probably would need to see tax legislation by the end of the calendar year. And it could be all the way at the end. If you recall the Trump tax cuts, those were finally signed into law in December of 2017. It was all the way at the end of the year. There was very little that one could do at that point when you now have the new rule book that you have to play by. So this sort of thing is very frustrating for everyone involved. Just know that that frustration is shared. But also know that it does matter what calendar year this legislation takes effect in, and that if it does not occur in 2021, then probably nothing horrible is going to happen to 2021 taxes. I know I'm starting to run out of time. Karl, give me just a few minutes to run through the end of my presentation. Having said all of that, what in the heck are you supposed to do about it? Well, in general, hey, meet with your CPA, meet with your investment advisor, meet with your estate planner. Everybody that's on this webinar, basically. You're already doing the right thing just by taking some time out of your day to listen to what folks have to say about this. But you definitely need to meet with the people that know you and your situation and your facts, because the advice can change dramatically based upon your individual situation. Let me say also that in general, our firm is giving to people the opposite advice that we normally give. Normally, we tell people defer income, accelerate deductions, lower your tax today. Now we would say do the opposite if you're worried about tax reform. Push off income, push it into the future, accelerate deductions now. You can even do that still on 2020 tax returns, possibly, especially if you're a small business owner, in terms of deferring depreciation and things of that nature. Last slide. Some specific ideas. Think about your retirement contributions. Those are going to be possibly even more useful in the future than they are now. Think about your investment portfolio. I'm sure Shawn would like to talk to you about that, and Karl would like to talk to you about that. Maybe try to shift into things that are tax advantaged. That's their world, not mine, so I'll leave that to them. Consider deferring the harvesting of tax losses at the end of the year. If tax legislation is occurring in December, we know it's going to happen. We know capital gain rates are going to go up. Well, hold on to those losers that you've got at the end of the year. Don't harvest them. Wait, harvest them later when you're going to get more bang for your buck. Invest in real estate. You're going to get depreciation. You're going to get write-offs that could possibly offset any cash that you're getting back. I lied. I have one more slide. If you've been involved in 1031s, you really need to talk to folks about that and what the consequences might be if they go away. Consider buying a ranch. Consider investing in your ranch. Get those write-offs. We're all about the write-offs. And I'll end it with, make sure if you have a small business that you are getting the maximum benefit that you can from owning that small business. Bundle your personal and business expenses as to the limit of legality. Consider hiring family members. Try to think outside the box and maximize those deductions for your business. And that does it for me. I apologize for going a couple of minutes over. Happy to talk to you later with any questions that you might have.
No, that's great, Eric. We did get one question real quickly before we jump over to Johnny Lane. Somebody, Scott Hobbs, asked, is the $400,000 for individual or married filing jointly?
Man, that is an awesome question. And the answer is that the white paper says nothing about that. It does not make it clear. Now, the assumption from people in my profession is generally that that would be family income. But what's also not clear is that gross income? Is it AGI? Is it taxable income? All of those things have not been answered. They're completely unclear. I will also add to that I would frankly be surprised if there is a line of that nature. I'm kind of surprised it's as high as 400,000. And it would not surprise me if that line came down to somewhere more around 200 or 250. Generally in the tax world, that's where people start to really experience an increase in their tax burden is a family income, a joint income of around 150, 200, 250. That's when it really starts increasing rapidly. And so I would be surprised if that number stays where it is now.
Right.
But anybody who's in that income range, let's say 200 to 500, yeah, you need to be worried about tax reform. Anybody that's over 500, they're going to try to hammer you as much as they can. That's what they're going to do. And so you need to do the best that you can to get your income down.
That's great, Eric. Thank you very much. Great action-oriented things too, especially deferring depreciation, accelerating income. Spot on. Thank you very much. All right, we're going to shift over to Johnny Lane to talk about estate planning. And really, there's probably a lot more in the air that we don't know about estate planning changes and rules. So I think, Johnny, you'll probably spend a lot of time just really covering things that we do know and helping people out in that regard. So go ahead and take it away.
Yeah, thank you, Karl. Really look forward to going through this presentation with you guys. Lawyers get paid by the word, and so I'll do my best to keep this thing short. That's why in every real estate deed you see the words grant, sell, and convey. They all say the same thing, but because lawyers used to get paid by the word, they use three words to say the same thing. Well, let me talk to you a little bit about estate planning. And one of the things that I want to do today is to dispel a lot of common myths that are out there. One of the common myths is that if you die without a will, the state comes in and takes everything away from you. Another one is that you have to do everything you can to avoid probate. Another myth out there is that trusts are only for the very rich. And then I guess the last one is that estate planning is expensive. So let me kind of get into this and let's see how this works. Let me start my little slideshow. And so like Eric, I too have a San Antonio and a Boerne office. In fact, we're kind of next door to ADKF in Boerne. So be glad to see you there if that works for you. So true or false, your estate escheats to the state if you don't have a will. The answer to that question is false. Now, Texas has laws to deal with your stuff if you die without a will. It may not be the same as you might have chosen. And that's why it is important for anybody in Texas over the age of 18 to have a will. Another true or false, a will is the only way for the heirs to inherit your estate. That is also false. I do think everyone should have a good will, but there are ways to pass your estate outside of a will, such as trust and some other ways. But a will is a good place to start, and for about 98% of us, that's about all that we need. What is an estate plan? Well, it does include a will. We also go through with our clients all of their beneficiary designations. It's a little known fact that all of your bank accounts, retirement accounts, life insurance policies, those pass outside your will typically. And so really the will is there for the most part to take care of ownership in any companies or real estate, and hard physical assets. We also include statutory documents. We're going to talk about them in just a minute. But then, of course, an estate plan might include trusts. So your last will and testament, the main thing is it names the executor, the person that's going to be in charge of probating your estate and making sure that your wishes are accomplished. It's going to identify your heirs, and it's going to specify what do the heirs inherit. One of my more favorite sayings of late has been that what is fair is not always what's equal. You know, if I have 4 kids and I think they should each inherit stuff equally, well, that may not necessarily be fair. I may have one child that has done very well, and I may have another child that's sitting in jail. And so we want to give them a fair distribution, not necessarily equal. Other uses for a will include establishing a trust, or maybe you want to disinherit someone, or maybe you want to forgive debts. But basically, a will makes it easier for your loved ones to take care of your stuff when you're gone. As the old saying goes, there's no U-Hauls on the way to heaven. We're going to leave it all behind, and we're going to leave it to someone. So beneficiary designations, whether it's a checking account, a savings account, investment account, retirement accounts, you designate who those accounts are going to go to whenever you die. You can name multiple people. You can name charities. A lot of the times we have problems with the states, it's because of beneficiary designations. We've had significant litigation over that. And so when we sit down to talk to clients, we always go through their beneficiary designations, making sure that those things do what you want them to do. The statutory documents that we typically include in our estate plan includes a durable power of attorney. One of the most important documents that we put together for people is this power of attorney. It gives someone else the right to manage your affairs, whether you're capable of doing them or not capable of doing them. And the biggest reason why this document is important is it avoids the need for a guardianship. If you become incapacitated, you can't manage your own affairs. The court wants to appoint a guardian for you. Guardianships are very expensive and very hard on people. With a power of attorney, we can avoid guardianship almost all of the time. Another very important document is the medical power of attorney. Again, you're in a position you cannot make your own decisions. Who's going to tell the doctors what to do, not to do, what medicines to give, not to give? Those are very important. We also include a HIPAA authorization, a guardian declaration, a directive to physicians. A lot of people still today call that a living will. I don't like those terms, so directive to physicians. Basically, the letter that says, "Dear Doc, don't keep me alive by extraordinary means. If I'm dead, turn me loose. Let me go be with Jesus." Disposition of remains, that's a document that if you wish to be cremated, donate your body to science, you need to have one of those documents in place. Talk real quick about trust. A lot of times we use trust as a tax planning tool. Many times we use them in certain situations. But for the most part, we tend to avoid trusts unless they are necessary because, again, they're a bit cumbersome and they're a bit expensive, increase the cost of your estate plan. A tax planning trust can help to avoid or minimize estate taxes, but we're only talking there about people that have above the unified credit limit, which today is $11.7 million. $23.4 million if it's a married couple. We, as Eric said, that is probably going to change. But if you have excess of that in your total estate, then we need to do some things in your estate plan, including doing some trust maybe in your will. This is generally what a tax avoiding trust looks like. Looks like a little bit of a complicated deal, but believe me, once we sit down and talk through it, it's not that challenging to get your brain around. We also have situational needs for things like special needs people. If you have a disabled child, we can do a special needs trust, or even an adult. Blended families, we do that a lot with blended families to protect assets from another spouse going off and squandering those assets. But the biggest one is asset protection, whether it's divorces or lawsuits or bankruptcy, whatever. Many times we'll use these trusts for asset protection, and that's very important to a lot of our clients. What do we do today? Well, we formulate an estate plan. We share that plan with your financial professionals, and of course, contact an attorney to prepare your estate plan and execute the will and statutory documents. What do you do later? Finalize all your beneficiary designations on all of your bank accounts. Don't forget those things. And a lot of us, when we opened up the accounts, we filled out the beneficiary designation. We haven't looked at them in years and years, and maybe things have changed and we want to do something different. So be sure that you review those periodically. I know, working with Shawn, that I can now change my beneficiary designation online. So if I get mad at somebody, I can change it, and then I get happy with them, I can go change it back. So we thank you. I have to give a quick little disclaimer. This advice is not intended to be specific to any individual. And if you have an individual question, you need to retain your own attorney. So thanks for letting me be a part of this, guys. Enjoy working with you.
Thanks, Johnny. Appreciate that. Yeah, it's going to be interesting over the next few months, probably next couple of years, in terms of what happens to the exemption primarily. And I think a lot of people are going to have to relook at their estates. But the most important thing is to just get those docs done and reviewed. A lot of people haven't done it in 15, 20 years. So appreciate that. And again, if you want to ask questions, we'll have some time at the end. Just go into the chat feature, submit your question. We'll compile them there, and then we can ask them at the end as we have time. Next up is Shawn Morris. He's going to be talking about the markets primarily, and he's another advisor along with me at Covenant. And Shawn, go ahead and take it away.
Thanks, Karl. I get to back cleanup, so I get to follow both of those fine gentlemen. When we talk about the economy and the markets, it's hard to talk about those and not weave in politics. I think going into the last three elections, everyone always get a lot of pushback on investing, or a lot of concern, or a lot of calls around, well, what happens if so-and-so gets elected? And so we wanted to kind of take a look at that and just show you that, as we look historically, markets don't discriminate by party. I think if you look, kind of Nixon and Ford, if you average those two together, you'd get a pretty decent average. And that, would be the equivalent of a two-term presidency. If you look at Donald Trump and Jimmy Carter, both one-term presidents, had the exact same returns. Trump was on pace for a very robust market, but had to deal with COVID, which really, dampened down that in the back end. George W. Bush was, you can see of all these presidents, the only one that experienced a negative return over his presidency. But if you remember, his first term started right out of the gate with 9/11 and ended with the global financial crisis, which didn't just impact the United States. So a lot of times, though, people will say, well, I just want to, I want to sit this one out. I don't really want to be in the market during this presidency. If we were to pick sides and try to just invest just on your preferred party, you can see you would miss out quite a bit. And I think the old adage of time in the market is more important than timing the market when it comes to politics. So that leads to the question, why does the market keep going up? A big part of that is just really, we have a flood of cash going into our economy right now, whether that's the stimulus or recovery packages being passed by our politicians, or it's an accommodating Fed that's keeping interest rates low. And then in addition to that, if you look at kind of this more recent run of the market, it ties in directly with the announcement of new COVID vaccines. So between the stimulus, the low interest rates, which are not only feeding the stock market, but also, I believe, the real estate market, and then the COVID vaccines, that is a lot of what is driving current market returns. Well, one of the things that I teased in, kind of the agenda was, what are the tactical trades and where are the risks? If we look at our stock market, a lot of times people, they look at the S&P 500 or the Dow as a measure of the stock market. What people rarely do is look under the hood. And I think one of the things that's really driven the recovery post, global financial crisis has been large cap stocks. And more specifically, especially of late, has been large cap growth stocks. The last time that we saw such a disparity between growth and value was the late 90s or basically early 2000s. And if you remember, that was the tech bubble. And that bubble eventually burst and we ended up with a tech wreck. That being said, there was still value. There were still stocks that did well in the, post tech wreck. And one of those areas were small cap stocks. Right now, the last time that we saw small cap stocks this inexpensive versus big cap stocks was once again the late 90s. And so this presents opportunity. Everywhere that we see risk, it highlights areas that we see opportunity. And so small cap stocks would be, we have started adding those into our portfolios. International stocks. The last time that we saw international stocks this inexpensive versus US stocks was, we had to go back to the late 60s, early 70s. And so this provides, on one end, it shows a measure of risk in large cap stocks, which we do feel like are overvalued, but there's an opportunity to diversify away from just pure large cap exposure and rotate some of our investments into international, both developed markets and emerging markets. We feel there's value in both of those areas. Another area is commodities. I think, if you talk to Karl, you can attest to this, that whenever people get worried about the stock market, it seems like they always want to go into gold. And they just, or if they think that inflation's on the rise, they want to go into gold. Like gold is the only safe harbor. Commodities represent another opportunity for value in our current market. If you look, the last time that commodities were this cheap versus was back going all the way back to the Great Depression. And this is not just gold. We want to have a developed basket of commodities within our portfolios. That being said, we don't want to be all commodities. We want to have this as just a piece of the puzzle. The stock market is not the only place that there's risk. The bond market has experienced about a 30 to 40 year bull market, primarily driven by falling interest rates. If those remember, back in the 70s, you could get double-digit bond returns, but we've seen these rates continue to go lower and lower and lower, and people are like, well, what about when rates go back up and get normalize? Well, I think that that period of the late 60s that peaked in the 70s was probably more of an aberration than it was the norm, and so even normalized rates may be only 4% range, kind of on average. That being said, the risks in the bond market are, one, low returns that don't keep up with inflation, and two, rising rates, which would impact bond prices. After seeing all that, you think, well, maybe I just want to sit in cash. If we look at cash, for the past decade, cash has failed to keep up with inflation. And so, a lot of times people, I have a lot of, clients or prospects, they're worried about a market crash, and they think, well, I'll just sit in cash until the market crashes, and then I'll get back in. One, when the market crashes, most people don't get back in. They're too scared. And two, if you sit around waiting, I had people all the way back to, the financial crisis saying, I'm just going to sit in cash. Well, if you sit in cash, what ends up happening is that you're losing to inflation. And so it's not something that we want to have a large cash position in our portfolios. So what's the answer? The answer is to have a plan. You can look back in the 90s. It was easy. This is something that pensions use. They kind of target a 7.5% return. In the 90s, they could sit in bonds and pretty much get that whole 7.5% return. And then a decade later, in the mid 2000s, they could still get that 7.5% return and keep a majority of their money in bonds, but they would have to start diversifying into large cap, small cap, international, add some real estate, maybe some private equity. Fast forward to another decade, and you can see that bond with interest rates as low as they are now has become a very small piece of that portfolio. And if you look underneath there, the volatility has increased. So it's to get that same type of return, we have to take on more risk, and we have to a little more complexity in how we build those portfolios. So what are we doing? What is Covenant doing? Well, we are with our guideline portfolios. We're looking to add allocations into value stocks to diversify from the S&P 500. A lot of people think that they have the S&P 500. Well, I'm diversified. But if you look at the what's driving, the traditional S&P 500 is cap weighted, meaning the larger the size of the company, the more it represents of the index. And really the index is being driven by about 8 to 10 big tech stocks, including Berkshire Hathaway, which has got which is historically perceived more as a value company, but their largest holding of publicly traded stocks is Apple. So they've been riding the Apple wave, just like the S&P 500. And then so we're looking to add value stocks, dividend paying stocks. As I showed on that slide, we're having a rotation into some small cap stocks. We want to use international stocks to diversify. There's value there. Commodities. In the fixed income space, an area that we've been able to find value is in mortgage-backed securities. They pay a higher rate of interest, and then we feel like they're undervalued relative to the rest of the bond market. Finally, we are allocating to private credit, and we're allocating to private real estate. Once again, it's another form of a diversifier. They provide much better income versus the traditional bond market right now. And then hedging strategies and long volatility strategies. For example, a long volatility strategy that we've used is that, as volatility in the stock market increases, they add volatility into their portfolio, which provides a hedge. Volatility usually means it's the market's on a decline. So we want to add diversifiers into those portfolios. Finally, I think kind of leave these two quotes up. We don't want to follow the herd. The market is perceived as frequently efficient, but it's not always efficient. So there's always opportunity. And then we want to, another way of looking at not following the herd is to be contrarian. So if you have a good asset allocation, you're always going to have assets in your portfolio that are underperforming. And those aren't a signal to sell those assets. Those are typically a signal to trim in the asset classes that are outperforming and add to the ones that are underperforming and get what I like to call it a forced sell high, buy low strategy. So with that, that's a pretty quick view of what we're looking at in the stock market, and we can open it up and look at if there's any questions.
Yeah, thank you. And if you guys want to come back on video, you can welcome to do that. Just a reminder for those of you participating, if you will get an email after this and it'll have a recorded copy of the presentation. So don't worry if you miss something. You're going to be able to rewatch this, share it with somebody if you would like. We know we're cramming a lot of information, but we really felt like at lunchtime, kind of doing a 1 hour was the best way to get this information to you as quickly as possible. As we do get some questions here, and I'll continue to monitor that. Just a reminder, you can go to the chat section there, type in your question, and we'll get to it. Gentlemen, after you gave each of your presentations, anything that you forgot to add or anything you want to clarify as we move along here? Go ahead, Johnny.
Yeah, I forgot to talk about one of the myths, and that is that estate planning can be expensive. Know that there are plenty of resources on the web that you can use for your wills and trusts and so forth. I just need to caution you that I can't tell you how many of those that I've seen come through my office that were not worth the paper they were written on, but there are exceptions to that. If you go to see a good attorney, you can probably put together a good estate plan for a married couple for around $1,000. Maybe some are less, some are quite a bit more. But if you shop around and you look for the right attorney, you're not going to spend that much money to be able to make sure your stuff goes where you want it to go.
No, that's a good point, Johnny, because a lot of people do feel like, what's the point? And to me, the value in meeting with an estate plan attorney is not just the customization and the docs, but it's more about the conversations you have. And you do a great job of posing those questions to people, making them think about what to answer. Because again, if you just fill it out online, you're not going to really understand all of it. And so you kind of get what you pay for, I think. And so the time spent with you is probably worth it as well. We did have one question, Eric, probably for you. Is there currently a caregiver tax credit?
No, that would be a new credit that would be established with Biden tax reform. There is an ability to possibly take someone as a dependent on your tax return, even if they're not your child, if you're taking care of them. That's a possibility. But at the moment, there is no caregiver credit. That would be brand new. And no clue what the limitations would be, what the requirements would be, et cetera, et cetera. But I think it would be envisioned as a way to assist people who are caring for their parents or perhaps siblings who have an ongoing life issue or things of that nature. So I think that would be one of the nicer things that would possibly come out of this is to help people who are helping others.
It does seem like this is going to be a challenging time, and we did get a comment that's thanking you guys for the presentation, so you're very welcome for that. It does seem like a challenging time that I don't believe the Biden administration is going to be able to push through really any of these things in 2021 with as many people that are still out of work. We have kind of this K economy we've talked about on our podcasts where, you know, those that have jobs are doing very well. The economy is recovering. Interest rates are going up. You know, we're seeing commodity prices rise. The stock market's doing well, Shawn said. But the people that are unemployed are really struggling, really falling behind. It just seems like it's going to be challenging for them to really push through a bunch of estate tax increases, income tax increases, at least this year. It probably seems like most of this might be a 2022 issue. Do you guys agree with that?
Well, I think the closer we get to the midterms, I think it becomes more dangerous, so to speak, because if I was in that position, I would be considering, well, how dangerous is it for me to keep pushing on this? Is that going to endanger my majority? On the other hand, do I need to come through with things that I've promised to people in order to secure re-elections? I personally think that you're going to have those moderates, those centrists, become increasingly more fearful of their position, and they're going to dig in their heels about wanting to vote for anything that's dramatic, let's say. And so I personally think the closer we get to midterms, the less likely massive tax reform would be. Of course, some sort of lesser reform could certainly happen. Some of these things could happen and some of the others don't. It would absolutely shock me if every one of those bullet points were to occur. I mean, that was more of a dream list or a hit list, if you will, an aspirational list rather than a realistic possibility. I mean, if you think about the Trump tax cuts, again, the mirror 4 years ago, all sorts of things were thrown around. there were all sorts of ideas talked about, and there was lots of arguing and back and forth. And things like the QBI deduction, which is huge in the small business world, that was thrown in almost last minute as an attempt to placate small business owners, because remember, President Trump was very focused on corporate taxpayers and reducing their corporate tax rate. And then small business owners, and I forget who it was, but I think it was a gentleman from Wisconsin or somewhere in that area, said, well, what about small business people? They're getting nothing out of this. And they came up with the QBI deduction, which has been huge the last few years for lots of people, and quite complicated, I might add. So who knows how the sausage is going to be made when it finally is made.
Well, and the key to all this is, I mean, we've seen since the first Trump tax cuts, you talk about CARES Act 2, PPP. We've seen a lot of changes, and it's confusing to a lot of people because some of them aren't changes. Some of them are just proposed and tossed out there. And so some people take it as, oh, I guess they're going to do this, or maybe I missed it and it's already in law. So this is going to be really challenging to navigate, which is why we wanted to put this presentation together. And I suspect it's not the last one we'll be doing, because you're going to have changes. And I think, to me, that's what all four of us do, is we try to walk alongside people as changes are coming along and help them through those changes for their particular situation, because we cannot predict what 5 years is going to look like. It's going to probably look dramatically different. And hence, it's hard to give somebody a financial plan and say, go execute this. It's a living, breathing document in our world, because things change, not only in their life, but tax laws and estate laws. Johnny, were you going to say something? I saw you reach for your mouse.
Yeah. Thank you. You're very observant. Yeah, that same is true with estate planning. People think, well, I did a will 20 years ago, and so I don't have to worry about that again. But, you know, we strongly encourage people to review their estate plans at least every couple of 3 years, because the laws change and situations change. And I've had some clients who say, well, I don't want to do my estate plan now because Biden's going to make all these changes. Well, the problem is, what happens if those changes don't come down the pike and you die in the meantime? We don't know when it's going to be our appointed time. So I just would encourage everybody to find a lawyer, get the wills and stuff in place. Don't put it off.
Yeah, time goes by really quickly. I was just reviewing mine because I had a friend pass away very suddenly here recently, actually a couple of friends, and it just caused me to look, and lo and behold, 2013 was the last time that I had updated this. And I've got now a child that's 18, so I have to make some decisions around being an 18-year-old. So there's kind of these moments in life. They could be death, it could be divorce, but there's things that are going to happen. But especially, it could be you having a child, it could be you having your first home, it could be, again, an inheritance. There's lots of things that make you review your documents, and a lot of people avoid it. I think, Johnny, correct me if I'm wrong, but 50 to 60% of people in this country die intestate, meaning without a will. Is that the right number? Or is it higher than that?
It's higher than that. It's over 70%.
Wow.
And that's really complicated and expensive when you die without a will.
Yeah, for sure. Shawn, one thing I wanted to point out, there was a slide in there that you talked about. You didn't describe it specifically, and it was one, and maybe you could bring it up. It was one about inflation. I think it's one of the most important slides. It was showing the amount of money people used to earn just on a money market or savings account used to beat inflation. So we knew people that would sit in their 401ks in the money market, and they were doing okay. They were still beating inflation. And you'll see over here, since the financial crisis, really past that, that's the slide right there. You can see in 2008 or 9, you'll notice that the little blue dashes are what inflation is. And that's the number, that's the amount of dollars you need to earn on a $100,000 savings account to beat inflation. So you can see from 2009 all the way until now, if you're sitting in the money market, you are literally falling behind, because the amount you're earning is less than the amount of inflation. And so it's kind of the frog in the boiling pot syndrome, is that slowly but surely people think they're being safe. And Shawn alluded to it. Well, I'll just not do anything. I'll just wait for the big crash. I'll wait for something. And what's happening is people are falling further behind. So I think it's key to diversify. And people say, well, how do I keep up with inflation? Well, number one is to invest in inflation, meaning That's why we have a small exposure to commodities. You hear about lumber prices going up and copper prices and I mean, home prices going up. Well, invest in those things. That's how to protect yourself over the long term. So, but I thought that was one of the most important slides in the whole deck. There is, it's a very different world than it was in the 90s when you could earn 6% in a money market.
And I think one of the biggest mistakes that people made the last decade is that they were like, well, I'm going to sit in cash and wait till yields go back up. And I mean, how many times have you heard people thinking the yields? I remember back in the early 2000s, I had someone, used to could get a CD that paid 7%, and had someone come into our office and their CD expired, and they were like, well, I want to look at rolling my CD. And when I gave them the current yields, they were like, hey, I want to talk to a manager. I got up from behind my desk and I introduced myself. I'm the manager. I mean, like, this is just what it is. I mean, I can't help it. I mean, but people were, staying in short-term bonds, 10, 15 years ago because they thought rates were going back up. And if we go back, that one slide I showed, rates probably won't go back up to like what we saw in the 70s and 80s. And, now unless we get something like hyperinflation, but, it's important to not just sit around in cash and wait for something to happen.
It's really about the direction of rates, because as you showed on that chart, we lived through the 70s. And so for us, that's our reference point. Well, surely they have to go back there, but this chart's great because it goes back 300 years. I don't know who was keeping track of this in 1714. I know it wasn't any of us, but you'll see on there that really the 80s were an aberration. I mean, rates getting up in the teens was highly abnormal. Having said that, we're on the lower end. So if we just go back to more normal rates, and let's say from 1.5% on a 10-year treasury to 4%, that's a lot of pain for the bond market. And so again, I think the world's going to be flipped upside down. What's perceived as safe investments, meaning bonds, are going to struggle like they are in 2021. So it's really important. Be careful what you wish for. Higher interest rates may be good on the money markets and CDs, but they may affect bonds. And also, the Federal Reserve is controlling short-term interest rates. They're saying those are going to stay low. So you're not going to get a raise in your money markets or CDs or savings accounts anytime soon. The long-term rates is what's going up right now, and that affects your borrowing, homes, cars, businesses, etc. So we got to be careful about that. But all right, we're about to wrap up here. Any last questions? Feel free to put them in the chat. You guys just go to your chat section. Again, we will send a copy of this video out to you via email, and you're free to share it. Guys, any parting thoughts before we wrap up here?
I appreciate everybody for taking the time to listen to us today.
Thank you, Eric.
To talk to you.
Can I throw a question at Eric real quick?
Yes.
Yeah, Eric. So a lot of my clients have businesses, farms, ranches, real estate. What's happening with the step up in basis in your crystal ball?
Well, that's another part of the estate changes that have been proposed, not really proposed, but the idea has been thrown around that in conjunction with changing the estate limit, that perhaps the step up would be done away with. Perhaps both would happen, which would be catastrophic to people in that situation, especially people who are trying to hold on to family land and so on and so forth. I mean, the thought from folks at my office is that it's got to be one or the other. Surely they wouldn't do both things to people at the same time. And the step up in basis has been around a very long time. And I'll also mention that I would imagine this is something that's very important to the kind of people who give these people money. And so just like the 1031 exchange keeps surviving over and over and over again, it would personally surprise me if the step up was done away with. That is so important to the donor class of people, frankly, that it would really surprise me if they would do that. But I'd love to hear your thoughts on it too, Johnny.
I have no clue what they're going to do, but I will tell you this. I have a lot of clients that are very concerned about that possibility. So they are writing their congressman and calling.
Well, guys, thank you very much. Appreciate it again, taking the time. And for all you guys participating, we're very appreciative of taking an hour out of your time. And we hope to do more of these. Please give us your feedback. Let us know what you wanted to hear. Maybe you wanted it to be 2 hours. Maybe you wanted it to be 30 minutes. I don't know. But anyways, have a great afternoon, and we'll see you on the next webcast. Take care, everybody.
Thank you all.
Thanks.